Hello and welcome everyone to the weekly Delphian meeting. Thank you for tuning in. So today we'll go through our regular process here, market update. We'll update the earnings trades, and Joe's got a few charts. Let's get started. So you can see still in state one for NASDAQ, SPX, Russell still in 8. And the pie is pretty much the same. I want to pull up the chart real quick. This is the last 2 weeks, the S&P pretty much in a 50-point range. Me and Joe were talking about that, pretty boring overall. So range bound and pretty boring overall. Okay, yeah, we're starting getting some changes in the sectors here. But let's look at the market pulse. So, we got down to a low of 36 here in the bullish. We dipped a little lower, kind of level, just kind of flattening out. If we typically, when we get these longer kind of flatten out areas, we will get a turn up. So we'll have to see if this, we can continue this kind of flat up and get a little spike. But, right now it's just kind of sideways blah, like we've been talking for a long time. So, but, if we can start, all of these are kind of like that. This one's shorter. This is a nice one here. It's, a couple weeks at the bottom there, just kind of flatlining, but you'll start to see the S&P build. Here, not as much, you get a little spike and then you get a real, well, I mean, obviously these are buy levels. We get that low in the bullish, but so, we're technically, we're at 39%, so we're not oversold, just kind of in the middle. But it's kind of crazy, that tight range. So, not your typical state one here. Pretty much just chopping back and forth between this 4,100. Still got some time, on average 43. So 28 trading days in, but really, what are the key things we've been hitting on? 4,200, that's the top of the resistance. 38's the bottom. We're a long way from that. But really, it's just been, this kind of range here, for a month, over a month, 28 trading days. So, and that's the range right here, this current state. So got close to the 42, turned around, in the low end, it's like 40, 50. So that's where we are with SPX. I'll put up on longer charts. It's not, I feel like I've been harping on this for a long time. 42, 38. So, I think we're up a little today. So, just key is to watch at 4,200. We have been, staying above the 50-day moving average. So that's something you can watch to the downside. 40.83, just call it 40.80 there. That's something you can watch to the downside. So obviously bullish runs, we like that 50 to be our support. And I think we're currently 41.50, so we're 50 points away from the 4,200, and that would be a key thing to watch. I wouldn't be surprised to get another kind of little false breakout, but we'll have to see if we can get up to that range. See what can drive us up there. I think Joe's going to talk about earnings. I don't think they've been, I think they've been, overall pretty good, especially for the bigger companies. So, but still have that market breadth problem. And let me go back to that real quick. Let me pull this up here. So this is the state 8, state 1, pretty much this level. There's our 7s, very little participation, 5s. So we're not getting I mean, to get bullish, we have to start seeing these 8s move. And we're not seeing that right now. And the 2s are pretty down far too. I mean, 7%. So where's all the bullish activity going to come from? If we can get that, that would be state 2s going back to 1. And then, all these 8s are going to have to start moving into 7. I mean, 5's dead right now. So still market breadth problem overall. And yeah, just kind of watch that 50, so 40, 80, and then, to the top, 4,200. Those are kind of the key levels right there. Obviously, this range I showed, 41 to 4150. I think we're right at the top of that 4150, that 2-week range, but that's not as important obviously as that 4200. So keep your eye on that. Here's Russell. 44 trading days, average 28. Pretty much right where we started. 1738, and we started at 1743. So pretty much, gone nowhere. No big falls. We did have that one test of 1700, and that's held up. I guess we had another one there, May 4th. Closed right at, the low was right at 1700. So that 1700 is the key support, I think, for the whole market, honestly. So got to keep our eye on that. Right now we're at 1770. And to the upside, we've got a ways for we're testing anything here. So really the upside test is going to be S&P 500. So that's 4,200. And then our downside is here, but we're decent ways off of that. But we're just still in the channel. I think some of the debt ceiling resolution, we could get a little bullish bump from that. Other than that, this is a moving target overall for the Fed. So, last week during our meeting, it was pretty much guaranteed that there would be no hike, and that's obviously changed now. And this is for June, I mean. So now we got 0.25% chance of a hike. A month ago, it was kind of right around here, but they also had a little cut factored in. So that's this is where we are currently, more towards that, no hike. July, similar, kind of no hike is the middle. This would be a quarter cut, that'd be a hike. So this one's kind of interesting that, they still have hikes kind of on the table, and that's a little, I don't know. I mean, obviously the middle here is, no hikes for basically 2 months. And then, we get into September, kind of in between a cut and a hike. So really it's like, okay, sometime, mid, late fall, September, November, we're getting cuts. And then from there, it's just everything's cutting again. So this is now 50 basis point cut in December. And I think that's all kind of shifted a little. Like last week, it was, 3 cuts of 0.25%. So, it's kind of shifting up a little. I don't, still think there's a big disconnect between, what the Fed said, no cuts this year, and, the market's obviously still pricing in, 50 bips of cuts. So, but they've come back a little from where they were. So I'm not sure what's going to happen here in the fall, but that's what the market's predicting right now. Something will happen and they're going to start cutting. So we'll see. I'd expect this, if the Fed holds to their, sticks to their guns, I'd expect this to keep moving like it has, just kind of inching this way and this way. And I don't think that's a, bullish thing overall for the market. So, I don't think it's, super bearish, or anything like that. I think, Fed wise, I would expect them to be pretty much near done. I would have liked them to be done raising a while ago. I think they overdid it here, but hopefully they stop. There's definitely not anything necessary to raise rates anymore. They're slowing activity, in the housing market, everything. So it seems like, we pull up all those M2 and stuff like that. It seems like things are starting to come down, but we're gonna have to watch the data. Nothing big out this week that I saw, just a lot of Fed people talking. So balance sheet, they didn't update it. We're still showing May 3rd here. So this hasn't been updated. I'd expect it to come down. They're making pretty good progress, to get back to where we were here in March. So I would expect this to keep coming down, and then, we talked a while ago about the previous balance sheet runoff, 15%, which is where we ran into problems. For this one would be around 75. And, we ran into some problems here, but, just kind of a marker, this was kind of where we would expect based off of the last time to run into problems. And, we ran into problems here, like way above it. So, but, they're going to continue the runoff. And I think they're going to hold rates higher. I expect them to do what they're saying. They've been following through on that. Obviously, they're wrong on transitory inflation, all that stuff. But at this point, I think they're going to be sticking to their guns. So,
hey, Josh,
yeah. Mm-hmm.
I heard something interesting on CNBC yesterday that I didn't quite understand. I thought I'd run it by you and Joe.
Yeah.
There was a commentator, it wasn't one of the regulars, who said that, I hadn't heard this before, that if they come to a debt ceiling deal, the Treasury, Janet Yellen in the Treasury, is going to have to do a bunch of borrowing, issue a lot of treasuries. Because, they haven't been, because they don't want to exceed the debt limit.
Mm-hmm.
So if the debt limit goes up, now they can go issue these treasuries to pay the bills.
Right.
And then he says, and that would be contractionary. I don't know, why is that?
Yeah, that doesn't make sense to me. I don't.
Yeah. And then he goes, along with Fed QT and this, it'll be, the second half is going to be more contractionary. So I don't understand why the issuance of all this debt, which, they would have done anyway, but now they're going to have to do it in very short order, is contraction.
Yeah, I mean, only thing the only negative, I don't see that argument. I mean, the rates they're going to be getting will be higher than normal. So they'll be paying more interest, but Yeah, I don't know. We get
Well,
into
I'm
like,
glad I'm not the only one who didn't understand it.
mm, yeah, I
Because
don't,
you know, just I'd never heard it before, and I said, well, why would this be?
yeah, I wouldn't think that'd be, I think they'd be more like offsetting, like what the Fed's doing, and then, okay, they're pumping a bunch of money out there, you know?
Yeah,
I mean, that's what they do. They loan the money and then, they're paying whatever their bills. So I
the
guess they're,
only thing I can think of is if with all these new treasuries, investors and banks choose to put their money there instead of the stock market,
yeah,
then that's the only thing I can think of would create this big bubble of treasuries making a contractionary. But I don't know if that's accurate or not.
yeah, but that's not like contracting for the economy. That's like contracting for, you know,
The
where
stock
the
market.
money, yeah, the market or, wherever the money was.
Yeah, right. Anyway,
That's just the flow of capital, people chasing the best return, the lowest
right.
amount of risk, which we've talked about ad nauseum.
Yeah, yeah. So I don't know. I thought I'd write you. It applies to this section you're covering. So I thought I'd
Yeah,
write
yeah. No,
I didn't
glad
understand
you
it much
brought it
more.
up. Joe, did you have can you
No,
break
Josh,
that?
nothing to add. But yeah, nothing at all.
I know they get into these like extraordinary measures and all this garbage, that they throw out there, but yeah, we'll have to see if they actually get this one resolved. I mean, typically they do.
I sure
Uh,
hope so.
yeah, I don't think it's good for anyone really, but
No, I still remember 2011 when they didn't. Was
hmm
not good for anybody.
yeah, yeah, it was a long time ago, huh? 2000, yeah, I was still in the military then.
Yeah. Well, market dropped 15%. We got our debt downgraded. It was not good. I remember, people not getting their Social Security checks,
hmm
VA benefits, all the national parks closed.
Yeah,
Uh, just the bare bones of the government was operating. And so, yeah, it was pretty painful. I think it lasted 3-4 weeks or so before they finally came to an agreement. But yeah, they actually did have to shut down a bunch of things. It was not pleasant.
hmm yeah. I read something about that is like, Treasury still did well, even though, the it got downgraded from like AAA or whatever, but the Treasury values held up the best, through that little stunt. So
Yeah.
yeah, it's good conversation. Okay, anyone else? Questions, comments? I had this other one. I've never really followed this. This is the sluice because they referenced it in that talk, and this is basically tightening uh, loans, and we pretty much covered that last week. The credit tightening. I think this is very similar type chart, but I didn't know. They overlaid the S&P on this. Um, so saw it, thought it was interesting. I haven't analyzed it that much, but obviously, it's not like a perfect. I mean, at some point things get too tight, where the market turns over, but they're tightening. Let me, a little tool here. They're like, they start tightening here and the friggin' like rocket ship up, right? But at some point, I mean, they dropped way down here, tightening. So it's not anything perfect, I think, but just definitely interesting. It's like, okay, when they are tightening, things could turn, right? And we are, when the financial conditions are tightening, things could get ugly. It's not like 100% thing, but um, you know, the one thing I also did see is there is typically a V bottom. Yeah, and that's where the Fed pivots type thing, so I guess we can just watch to see, okay, where's the bottom on this? And once we see the V, then I think that might be our all clear, right? But yeah, a lot of these do have that kind of V type thing. It's like tightening, 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 Fed flips, things start opening up. There's your one way to at least kind of see the bottom. So,
And Josh,
yeah. Mm-hmm.
just one thing, if you could leave that up, just,
Yeah.
the one thing when we were talking about it a little bit from an earnings perspective, we may ask ourselves, well, why hasn't the S&P, corrected more? According to Yardini, well, and anybody really, going back, in 2009, the S&P 500 companies earned $60 a share. Through 2022, that number's $218.
Right.
And, they've generated, so we've gone from, almost 4 times. And, the expectations for this year and next are higher than that. So, if we're looking for a reason as to why that black line hasn't started to follow the red line a little bit, that might be it, just the underlying earnings.
Yeah. Yeah, good point, Jim. Thanks. Okay, other general market questions, comments? I know it's been kind of lame, with the sideways market. Still stuff going on, but it's just,
Hey, Josh.
Yeah.
We talked that the market's been going sideways for a month, the S&P and the Russell 2000. Have you seen this previously? And if you have, what was the outcome?
Nothing comes off, I'd have to research it. Nothing comes to mind. These kind of environments, you just kind of forget about them because, they're boring, right? It's not like, oh, this happened, or, US debt downgrade, stuff like that. So nothing comes to mind offhand, but,
In
you
terms
can
of
always,
the trading range, Josh?
yeah, like,
Yeah.
just kind of like sideways for a month type thing.
Well, we had Russell. The time period, wasn't Russell freaking sideways for, damn near 8 months? Not too long ago.
Yeah. But that was kind of like I'm trying to like say, like, okay, how the current conditions are where, this is 1, Russell's 8, just,
Yeah,
that was like Russell 1, and it, like kind of bouncing back.
agreed. Big difference.
Yeah, definitely. No, we'd have to, you can go in the market pulse and kind of check that and just kind of go back and, but nothing particularly comes out. We will break this range, and it'll probably be, pretty significant move, once you do that.
Right.
So,
All right. Thank you.
mhm. Yeah, if they don't come a debt ceiling, that's definitely gonna, tank. I would expect it to be, kind of like Sadir summarized for that 2011 is like down 15. I'd expect, that kind of move if they don't resolve this. Okay, earnings has not been a good quarter, I'm not gonna lie. Bullish runners, we're down. Where I showed you guys the pre-runners that went down. These still have 5 open trades. 4 of them are down. So we had this one is obviously a big one. So 1, 2, 3, 4, 5 losers so far in the close. So, definitely not a good overall quarter for the bullish trades. The bearish are, I think we had the bearish runner. We had one of those close out. So we got one to open. Yeah, three of them closed out. They all hit the profit target. Same thing with the bearish pre-runner, but we just don't have that many bearish trades overall. The non-movers got two open, those are both down. So we have till Friday for these things to come back. CF and Pfizer. We do have three closed out, pretty healthy profits on those. But it's still showing down because the ones that are open, those are outside our band. So this one's at 37, our lower band's 37.50. So we need to get above that. Same thing here, 67, we're 65. So we can get a little move out of these, recover that cash, and this can help make up for some of the other losses. But right now it's just not a good earnings quarter, and we see that every so often. So I think last Q1 wasn't good. Last year Q1 wasn't good, and before that it was a while before we didn't have a good one. So, but so that's where we are on earnings, and pretty much closed out. I don't think there's much more. We got about a month till the next release. Things just keep coming back at you. Let's see if there's any other. We got some bearish runners coming up, non-mover. And I think these are all next quarter type things. So 1, 2, 3, 4, like 5 trades left. So hopefully you can turn around. Any questions on that?
No, I'm having a similar result.
Yeah.
It's marginal. It's just one of those quarters that it's not, I don't think it's going to end profitable.
No, it's not looking like it. So, well, next quarter we'll have less trades, and that's the way it goes occasionally.
Yeah, I think one of the things about the earnings plan that has developed, that's been refined over time, is it's self-adjusting. So, yeah, it'll adjust to more accurate, or fewer trades next time.
Yeah.
It happens.
Yeah, definitely. And I was kind of looking at what I typically look at, like I'm like, well, this should have, like, because this is the earnings plan release, right? March 15th. Like, this should have been good, but I think the problem was the breadth, right? So we put the plan out here, first trades are kind of like in here, but it's pretty much sideways, right? And even, after April here, it's been slightly bearish, but it's just been sideways. So whereas like here, December 15th, so first trade around here, obviously gonna be a great quarter. But I think kind of instead of looking at S&P, which can be drug up by a few names, kind of looking at this more equal weighted, or even the Russell, because market breadth, how many of the big S&P names are in the trades, Apple and Microsoft. Most of them are outside of that. So we'll keep refining, and okay. I think that's it. Joe, you ready?
All right, Josh, just a couple quickies. I think maybe also the fact that maybe by this time next week we'll have a new website, you think?
Knock on wood.
So, a new website is just, it's a start. We've been talking about it a long time. The new UI is what's critical. We believe we're making progress there. Certainly Josh and I are behind the scenes, but getting it implemented into production, has taken longer than we had hoped. So starting with the website and hopefully next week. So, we'll see. In terms of, let's see, a couple things. Josh mentioned the earnings, 92% of the earnings, and this is the old fact set information that comes out weekly, with 92% of them having announced. 78% have exceeded expectations versus 77 last week. The 10-year average, according to FactSet, is 73% beat. I haven't really had time to go in and try to find a source for or track, what the lowered expectations are going in. We've talked about this before. So if anybody finds a source where they monitor or throw out a figure how much earnings expectations have declined in the S&P 500, that'd be very helpful, I think, to all of us. I haven't found it. So I think that keeps that beat expectations number really a kind of a moving target. But, the numbers are good. Yardini's still looking for, 325 for fiscal year 2023, and then 250 next year. So we shall see. In terms of the ETF adjustments, just like the markets, virtually almost no change whatsoever. Last week there were 6, bullish ETFs and 5 bearish. This week there are 5 bullish and 6 bearish. The only, couple that have changed, and why I'm on the home page, I think, always a good idea just to keep an eye on the state of the bonds. And, they're moving around a little bit, but in terms of, the industrials, just slipped from a 2 to a 4, and just really, it's pretty indicative of the markets. Sideways, not much happening. First day into it, this is a 2-week on average move, down 4%. So that's one of the slight adjustments. The other one that actually moved it had been bullish, moved to bearish, but we're talking 5 to 6. But then again, it's the utilities, and sometimes the utilities foreshadow some bond movements. So worth keeping an eye on. That's a pretty big red bar yesterday, and along those lines, there's the TLT still laying around in the state 8. Rates are if anything's a catalyst for moving this market, I think it's rates as much as anything, with the exception of Josh's, what are they breaking, and what's the potential for war. So and rates certainly have ticked up, but still really within the range. Josh has been talking about 3.5% forever. I think we're a few ticks away from that. We just happened to get down to about 332 inside of the last week, and are now above that. And from a chart perspective, not much. Let me see, XLF, but what's it? Microsoft. Yeah, I just wanted to point out that Microsoft, has been in state 1. You had the big gap, but the fact that it's hanging above state 3, is pretty, or target 3 is pretty interesting. That's a 307 level. So, just one little thing to keep an eye on. I did, let's see, XLF, along with the, regional banks, that's obviously been in state 8 and has been dreadful. And actually, I think from a day's perspective, it's doubled. So, not even a dead cat bounce there, which I guess is not surprising. And XLF just kind of sideways inside of state 8. So, overall, I maybe try to keep an eye on XLF, but, still got a solid almost 3 weeks of trading, to go there. the one thing that I haven't mentioned in a long time, but especially in times like this where the market's sideways, I don't know how much time each of you spend in the platform, but it is such a phenomenal resource to go in and find ideas. And, when we get into the new UI, I think, we'll get into this some more, but, this whole idea of, the scanners and the predefined scanners. I mean, how many do we have in here, Josh? I mean, it's just, there are tons of them. And, what's that?
I lost count.
Yeah. And, to each of us, we all have our own interests in terms of how and why we watch the market, generate different trading ideas, and then, maybe run with them based on your expertise and your interests. But I would just encourage you, if you have the time, I mean, it can be so much fun. And then, with good risk reward and some back testing can be rewarding as well. But these predefined scanners, there's so much here. And we're going to, once we get the new UI in place, I mean, Josh and I will spend time adjusting some of these things where we think, there's so much here now, it's kind of over the top, but there's a little something for everybody. I would encourage you, get in there, play around. If you have the time, try to find some ideas, some recipes for winners. I like the gap ups and the gap downs personally, to then go in and kind of analyze things just as one potential area. Implied volatility, certainly another one. But nothing more than just an encouragement to go in and kind of play around, have some fun. If you come up with some good ideas, and this is a great group you want to share with us, we'd be happy to hear anything you find. And as Josh and I get away from some of the minutia that we've been working on for too long, we'll get into some of this, and certainly look forward to sharing some ideas with you. So
I have an idea I'll throw out. You there?
Super, Sudhir.
We've been commenting that the market has been going sideways. So, I just finished the semester, so I haven't had time. So I was trying to think of some parameter to test, and what would, in a sideways market, how would 30-day iron condors on the S&P work out? Because if the market's going to go sideways, an iron condor should generate money. But you follow what I'm saying?
Oh, 100%. And
but I don't know what
no
criteria, what is the criteria you would put in the actual screen to say the market is going sideways? You know what I'm saying? Don't know what concrete thing to put in there.
Right. And no BS. Literally, Josh, it was either yesterday or the day before, we were talking about the whole iron condor idea inside of a market like this. Time spreads, depending on implied volatility, can be low risk opportunities, assuming you pick the right strikes, in a sideways market. But yeah, coming up with specific criteria, Sudhir, is certainly doable. For Josh and I, it's just a question of, having the time. And until we get this damn new UI up and rocking, we're short on time. But the idea makes all the sense in the world.
Yeah, I would throw out the iron condor. Let's say you do each short leg at a delta of 20. But what is the condition you do it under that gives you entry dates when the market is going sideways by definition? That's what I can't quite figure out. So something to think about. I don't expect an answer here, but
right.
If you define the condition, lately iron condors 30 days should have been working.
No doubt about it. In a big way, I would think. So thank you.
All right,
All
Joe,
right,
did you
well-
have anything else?
Nope, Josh, nothing else, back to you.
Okay, anyone else got questions, comments? All right, we'll close it up. Thank you all for attending. Do it again next week.
Thank you.